Hey everyone, welcome back to Corporate Decoder, the place where we break down the dense language of corporate filing so you don't have to. And today we've got a financial report that looks like a novel, but stick around because we're going to give you the Cliff Notes version of what it all means. And trust me, there are some juicy details in here that will make you rethink your investments before we dive deep into this report. If you are new here, hit that subscribe button and ring the bell so you don't miss out on our regular corporate breakdowns. And if you want to connect with a community of savvy investors, join our Discord server linked in the description below where we dissect these filings together. Alright, so what are we looking at here? This is an annual shareholder report for the American High Income Trust, and it's been a busy year for them. Let's get straight into the financial meat of it to see how this trust is really performing for its investors. First off, let's talk about costs because money talks right for a hypothetical $10,000 investment in their class of shares. You would have paid around $73 in cost. This is about 70% of your investment. Now compared to Class C shares, that same $10,000 investment would cost you $149, which is 144%. This means Class C shares are almost twice as expensive for the average investor compared to Class A. Now let's talk about performance. The class of shares actually gained 718% for the year. This sounds good, but it actually trailed behind the Bloomberg US Corp High Yield 2% Issuer Capped Index, which saw a gain of 741%. So while Class A did okay, it did not keep pace with its benchmark. Now for Class C shares, which were more expensive, they only gained 639%. This is a significant underperformance compared to the benchmark and even class of shares, despite costing more. Let's visualize how that 10,000 would have grown over time for class of shares excluding sales charges. That 10,000 investment has grown by 718% in 1 year now. Looking at the longer term over 10 years class, shares have provided a return of 617% without sales charges. Compare that to the Bloomberg US Aggregate Index, which only saw 184% over the same period. That is a pretty big difference, showing the trust is doing better than this broad market benchmark. But when we look at the Bloomberg US Corp High Yield 2% Issuer Capped Index, an actual comparable index, it delivered 616% over 10 years. Very close to Class A's performance, suggesting the trust is tracking this sector well. Let's look at some high-level numbers for the fund as a whole. The fund has a massive $25,988 million in net assets. That really is a lot of money. That means it holds over 1,000 different investments in its portfolio. The total advisory fees paid were $65 million, which seems like a lot, but when you consider the total assets, it is actually quite reasonable given the scale of the operation. Now for the juicy part, the actual investments, this is where we see where all that money is actually going. The trust heavily invests in bonds, notes, and other debt instruments at almost 88%. Let's zoom into the corporate bonds. The biggest chunk of this is in communication services, making up over 14% of the portfolio. Then we see significant holdings in energy at over 12%. And consumer discretionary at over 10%. These are the main areas where the trust is placing its bets. Digging into the specific bonds, we see holdings like CCO Holdings LLC with various interest rates spanning from 425 to 7,375%, maturity dates stretching into the 2030s. These are long-term bets. There are also substantial holdings in EchoStar Corporation, Direct V Financing LLC, and Charter Communications. Operating LLC, this tells us the trust is deeply invested in companies with significant debt loads and exposure to media and telecommunications sectors. In the energy sector, we see a lot of companies like Synovus Energy, Inc., Petrobras Global Finance, BV, and California Resources Corporation. These are companies dealing with oil and gas production and refining, which can be very sensitive to global energy prices and economic conditions. The fact that they are also heavily invested in bonds from these companies suggests a strategy that might be about capturing higher yields from these potentially more volatile sectors. Looking at consumer discretionary, we see brands like Ford Motor Company and Macy's Retail Holdings LLC. This sector can be a double-edged sword. If the economy is strong, people spend money on these types of goods and services. But if the economy falters, these companies can struggle. Companies like Ford Motor Credit Company LLC are also heavily represented, which means the trust is also exposed to the financing arms of these businesses. In the financial sector, we see names like Block Inc. and JP Morgan Chase & Company. This is pretty standard, but also important to watch because financial institutions are often early indicators of broader economic trends. Their exposure here could be seen as a bet on the stability and growth of the financial system. The healthcare sector has investments in companies like Centene Corporation and DaVita Inc. This sector is often seen as more defensive because people generally need healthcare regardless of economic conditions. The trust seems to be leaning into this stability with a significant allocation here. Now let's look at the trust itself as a whole on the 30th of September. September 2025. The fund had total net assets of a massive $25.988 million. That is a huge number. It shows the trust is a major player in the market. The total value of its investment securities was over $25.718 million, with an initial cost of over $23 billion. This difference between cost and value is where we see unreal gains and losses. The fund also had a significant amount of cash at over $62 million, which can be used for redemptions or new investments. Every share class has a net asset value of $995. This is interesting because it suggests a consistent valuation across all the different share classes, which is a good sign of stability, even though different share classes have different expenses, which we saw earlier. The underlying value of the assets remains the same. Let's break down how the trust made and spent its money over the year. The trust earned a whopping $166.5 million in income, primarily from interest with advisory fees at around $65 million and other expenses around $65 million. The fund is clearly managing its costs reasonably well, considering its size. The net investment income was over $535 million, the trust also reported. Net realized gain of over $84 million and a net unrealized appreciation of over $91 million. Which means the value of its investments went up overall. Looking at the statement of changes in net assets for the year ended the 30th of September 2025, the fund saw a net increase of over $712 million from its operations. On top of distributions paid out, shareholders saw a net increase of over $426 million from share transactions. That means more money came in from new investments than went out through redemptions. This indicates investor confidence in the fund's performance over this period. Now, for some housekeeping and legally important stuff. The report says that Deloitte and Touch LLP left as the fund's auditor and PricewaterhouseCoopers LLP took over this change. Happened late in 2025. It's important to note that the report from Deloitte states they had no disagreements with the fund's management on accounting practices or disclosures. This is usually a positive sign that the transition was smooth and not due to any major red flags. So what does this all mean for you? The American High Income Trust is a massive and complex fund that is performing well by keeping pace with its high yield bond benchmark. It has a diverse portfolio with significant exposure to communication services, energy, and consumer discretionary sectors, which are all sensitive to economic health. The trust is generating substantial income and seeing positive gains in its investments. The costs are managed reasonably well, especially for the lower expense share classes like Class F-3. Despite the sheer scale of the operation, the change of auditors at the end of the reporting period seems to have been a routine management decision and not triggered by any disputes. This trust is definitely a major player, and for those looking for income in the high yield space, it demonstrates a solid, if not leading, performance. We've seen its net assets grow considerably, and that indicates investors are still finding value here. But remember, high yield bonds always come with higher risks, so it's crucial to understand that going in. What is your take on this report and the American High Income Trust? Let us know your thoughts in the comments below, and remember to smash that like button. If you found this breakdown helpful, it's the best way to support the channel. And of course, subscribe and hit the notification bell so you stay updated on all our corporate deep dives. And don't forget to join our Discord community, linked in the description, to continue the conversation with fellow analysts and keep decoding those corporate documents together. Thanks for watching, and well, see you in the next video.